For the longest period of time, the US has enjoyed having control over the majority of global trade, having US dollar dominance, as well as ownership of the major banking and payment systems. However, major risks to this dominance are now materializing with the emergence and rise to power of the BRICS nations, who are rapidly gaining momentum as the group continues to grow in both size and also power. And with it now looking like trade wars are only going to continue in the coming years, this attack on the US dollar and trade dominance is only likely to be enhanced, and there is data that suggests that BRICS countries could look to harm the US economy in more ways than one. Now, the BRICS bloc of nations have been growing their share of global GDP as they recruit new countries to the group and now account for over 36% of GDP at purchasing power parity, almost 40% of all industrial production, and also around 30% of all oil production. And during the BRICS summit in Kazan at the end of October of 2024, 13 new additional countries were announced to be joining the BRICS bloc, including Indonesia, Malaysia and Thailand. It seems that these BRICS nations have now hit a critical point where they are now rapidly making plans to move away from their dependence on the US dollar, introducing a new payment system called BRICS Pay. Now, BRICS Pay is intended to be a bigger and more efficient BRICS version of the SWIFT payment messaging system, which will facilitate transactions between BRICS nations that will be settled using their national currencies instead of the US dollar. One of the main reasons why these BRICS nations want to move away from the SWIFT payment system is because SWIFT is controlled largely by Western nations, in which the US has a large say in how it is controlled. This gives the West a lot of power to implement economic sanctions, such as blocking countries altogether from accessing the SWIFT system, something that is essential to settle trades in US dollars. We have of course seen the weaponization of this system a number of times already in the past, with Russia, Belarus and Iran all being countries that have been banned and disconnected from the SWIFT payment messaging system. This means that these countries cannot obtain foreign currency or transfer assets abroad, which does have negative consequences for the country's economy. And in fact, we are only seeing the number of active US sanctions increase over time, meaning that the Western currency, banking and payment systems are being weaponized more and more. The proposed BRICS Pay system will be highly sanction resistant, which is likely to be one of the main reasons why these nations want to accelerate the transition to this payment system. Now, shortly after being re-elected as US President, Donald Trump came out with some very strong words on social media threatening the BRICS countries over moving away from the US dollar to create their own BRICS currency. Trump stated that if this does happen, they will face 100% tariffs and should expect to say goodbye to selling in the US economy. They can go find another sucker. There is no chance that the BRICS will replace the US dollar in international trade. Now, with Trump using tariff threats as a negotiating tool, even if he doesn't choose to implement them at this scale, imports from these BRICS nations that he is targeting could be impacted by higher prices even with smaller tariffs. And Census Bureau trade data shows that in 2023, the BRICS nations together accounted for about $578 billion in US imports, with China being responsible for the vast majority of this trade at about $427 billion. Now, these top import categories from China include cell phones and other household goods, computers and toys, games and sporting goods as well, while pharmaceutical preparation is the top import from the rest of the BRICS nations. And some companies, including Walmart and Columbia Sportswear, have already said that they are preparing to increase prices should Trump implement tariffs on key trading partners. Now, with all of the various geopolitical issues going on in the world right now, there is a lot of movement in various stock and commodity prices. And for those looking to make the most of the current market conditions with their trading or investing, Moomoo is a great platform to give a try, and they are kindly sponsoring today's video. Moomoo's platform has a vast technical analysis toolkit of over 100 indicators, 45 drawing lines and 6 chart types for a more informed trading experience. They have a 24/7 news function that integrates more than 50 professional and quality news sources to give you the latest investment news and global market information, giving you the key information needed to make quick and informed decisions. Moomoo also offers 6 types of conditional orders, including stop loss and take profit, enabling you to capture potential profits and manage risks more effectively without the need to constantly monitor the market. Furthermore, Moomoo supports pre- and post-market trading, fractional share trading, and is also one of the lowest cost trading platforms with zero commission on stocks, options and ETFs, with no minimum deposit requirement and no account maintenance fees. Now is a great time to join Moomoo, as there are a number of great incentives they are offering right now. If you are a new user, sign up using my link in the description and make a qualified deposit to receive up to 15 free stocks, along with a boosted rate of 8.1% APY for 3 months up to $20,000 on idle cash. So sign up to Moomoo today by using my link in the description or in the pinned comment. While Trump's hard stance on the issue of countries moving away from using the US dollar could work out well for the US economy, there are a number of fears that these potential aggressive sanctions could harm the relationship with large trade partners, especially China, escalating the trade war. Now, oil trade between the US and China was massive in 2023, driven by large Chinese demand, and China was the second largest customer of US crude oil exports in 2023, behind the Netherlands, averaging 452,000 barrels a day. This was more than double their 2022 volumes from the US, while Chinese crude oil imports overall in 2023 were the highest since 2005, with significantly more oil coming from Russia as well. However, things took a bit of a twist in 2024, which began with Biden's escalation of the trade war with China, implementing hefty tariff hikes on China across many critical industries and sectors like electric vehicles, semiconductors, and solar cells. China is now striking back and weaponizing their own industrial demand by finding alternative sources for importing crude oil from countries like Russia and Iran, which means they are buying far less oil from the US. US crude oil exports to China plummeted by almost half in 2024, going from over 150 million barrels in 2023 to just 81.9 million barrels in 2024, knocking them down from being the second to now just the 6th largest buyer of US crude oil. It's looking like Trump is going to continue this trade war with China, so this Chinese demand for US oil may not ever come back, which is a big problem for the US, who need buyers, and it's looking like Trump is now turning to Europe to make up this demand gap. He recently posted on Truth Social, "I told the European Union that they must make up their tremendous deficit with the United States by the large-scale purchase of our oil and gas. Otherwise, it is tariffs all the way." The big problem here is that there are many US liquid natural gas projects under construction and set to come online in the coming years, shown by the blue bars in this chart, with the hope that this export capacity will approximately double in the next 5 years or so. The US therefore needs to keep demand for their energy high, and ideally for it to keep growing in order to make these projects worth completing. If China and the rest of the BRICS nations cooperate to move away from US energy imports, and instead move towards getting most of their energy from Russia and the Middle East, then the US could have a problem with a lack of buyers for their oil and gas. We're already seeing central banks from countries around the world move away from holding US treasuries, with the big one being China, and this money is increasingly being funneled into gold instead. Here we can see that the US debt as a percentage of total debt held by foreign central banks has fallen from 70% in the early to mid-2010s to now being below 50%, and the trend is only going downwards as more countries reduce their exposure to US debt. Meanwhile, over this same time period, gold as a percentage of central bank currency reserves has grown from being around 14% to now being close to 20%. We're also now seeing more and more concerning signs in the bond market, with US Treasuries crashing in price, driving yields up at the same time that the Fed is cutting baseline interest rates. In fact, in the time it's taken for the Fed to cut rates by a full percentage point, we've seen long-term Treasury yields rise by a full percentage point, something that we have never seen before. 10-year Treasury yields have risen from 3.7% in September to now being 4.7% just a few months later, and at the same time 20-year Treasury yields have risen from 4% to 5% over that same time period. These yields are now approaching the same highs that were seen in October of 2023 at the peak of the rate hike cycle, which are at heights that these Treasury yields haven't reached since 2007, around the same time as the global financial crisis. There are a number of reasons why we are seeing US Treasury yields surge, but ultimately it boils down to there not being enough demand to match the supply of new government debt being offered. In other words, investors such as global central banks are seeing more and more risk with holding US debt and are dumping their treasuries, or at the very least demanding a higher yield to be happy with holding them. Meanwhile, the US government is issuing more and more debt as the total debt pile rockets and interest payments on this debt continue to surge, only contributing to more debt being needed to be taken out in the future. We are now seeing a number of key economic indicators point towards stagflation, and with it we are now also seeing more warnings coming from many large financial institutions about a potential hard landing for the economy. My previous video goes into more detail on this topic, and you can check it out by clicking on screen right now. Aside from that, please leave a like on the video and subscribe if you enjoyed it, that does help out the channel a lot. Be sure to check out Moomoo as well, all the links are in the description, and thanks a lot for watching.